Hello everyone, and welcome to the fifth already episode of this video blog World Economics, where we try to respond to a few of your questions and ideas that we have been talking about recently and the recent developments in the global economy. If we look at the data that we have seen of the global economy in the last months, I think it's pretty evident that we have quite a discrepancy. This idea of global slowdown that we hear in many conversations is actually not that correct. There is a significant difference between the slowdown of China and the slowdown of the US economy compared to that of the Eurozone in particular, or Japan. Let's start with China. The data from China, the PMI index of the first quarter shows us that the economy is slowing down, but still in expansion phase. That means that the PMIs are above 50. So what is happening with China is very evident. China has two economies. On one side, it's got the old economy, where the government-linked companies, where the state-owned enterprises, where everything that has to do with the low productivity, high capital expenditure sectors is slowing down aggressively. And I think that is where the Premier of China has been talking quite a bit about the reforms that the economy needs in order to address that slowdown. So the old economy is obviously slowing down much faster than expected. Why? Because China is not a developing country anymore. It's actually more akin to a developed economy. And as such, what it has is another side of the economy, which is the high productivity, high technology sectors. Those are thriving. Those are doing extremely well. And actually the level of growth is better than what we have seen in previous years. But the overall slowdown of the economy happens because it's less dynamic. The level of debt is much higher. And the government's obsession with GDP is making it avoid the necessary reforms. So we need to be aware of those two economies, and that if the government continues to decide to perpetuate the imbalances in the old economy, it might end up hurting the new economy. So let's look at that from that perspective. It's a slowdown, but it's a moderate slowdown, and we're not talking about an economy that is in any shape or form in stagnation like the Eurozone. In the US, we have seen GDP, and it's very interesting when we talk about GDP because it's important to talk about the components. Yes, GDP growth in the first quarter was much better than expected, much better than consensus. However, large proportion of that came from inventory revaluation and inventory build. That can be a double-edged sword, because on one side, if inventories rise, it could mean that companies are confident about the future and they're building inventories, they're producing more goods and expecting to sell them at a higher price in the near future. It might be like that. It might also be that that these companies are building inventory because they're unable to sell the products that they have been putting in the warehouses in the last months, and that there's a sort of artificial revaluation of those inventories. We can look at it from both sides. How are we going to know if that is a negative or if that is a positive in the next quarter? We will see it in the next quarter, and we will also see it in the working capital build of companies as they publish their earnings. So we need to pay attention to that. But however, even if we strip out the effect of the inventory build in the growth of the US economy, it is still a very, very, very healthy +2% growth compared to other economies globally. So we need to look at that granularity of GDP, and that granularity of GDP is very evident as well in the stagnation of the Eurozone. Why? Because when GDP is better, because the external sector component, which is exports minus imports, improves because imports collapse, is not a good thing, especially if exports are also coming down. So we need to be very, very aware of that. We need to be aware also of artificially pumping GDP via public expenditure and via debt. That is very, very typical of the peripheral Eurozone economies. We have seen it in Spain, we have seen it in other economies. So sometimes we hear robust GDP growth, and robust GDP growth means more debt and more government spending and less exports, but much lower imports. And that reminds us a little bit of 2008. It could be one of the drivers of that worsening, because when it reverses dramatically. So we need to think about what is happening in the Eurozone, because yes, the PMIs in China worse, but still in expansion above 50. But the PMIs in the Eurozone are showing contraction figures. And they're showing contraction figures already in the latest data, which means that it's not seasonal, it means it's not temporary, and it's definitely not something that we have to sort of ignore because everything is going better. And the reason why it's not going better is because countries in the Eurozone have completely abandoned their reform agenda in order to bet it all on an improvement based on monetary policy. Monetary policy as the driving factor, when you avoid reforms, ends up working as a boomerang, because the ECB is trapped. It cannot increase rates, and it needs to continue to inject liquidity, but credit growth, improvement of the economy, productivity, leading indicators, or point to negative indicators. So we need to be very aware of that, because the slowdown of the Eurozone and the slowdown of Japan have nothing to do with the slowdown of China and that of the US. Emerging markets are improving. Emerging markets are improving because the price of commodities has been rising in the last 3 months. However, we need to be also at least checking a couple of red flags. Number one, Turkey, and number two, Argentina. Remember that last year, the first red signals on the economy already came from countries that massively destroyed their currencies with the incorrect monetary policies. As such, we need to be at least aware of the possibility of a rising risk in emerging market currencies. Let's see if it translates to others. And why? Because most of the improvement in commodity prices, in risky asset prices, and in bond yields has come from liquidity soaring. And when liquidity soars, but macroeconomic data worsens, we can get a couple of scares, at least in markets, and we definitely need to pay attention to the fundamentals, the earnings, the improvement in the underlying economy. So let's take a step back. If we look at the global situation, it is true that the stimulus in China has created a sort of bounce effect short term, but the slowdown of the old economy has deeper roots than that, and we cannot expect that to improve, and more importantly, we cannot expect the high productivity, high technology sectors to completely offset in GDP the state-owned enterprises and the housing market. So that is likely to continue despite the stimulus. The US economy is stronger, but it also has important challenges. The most important challenges are obviously the high increase in debt, and the other important challenge is that the economy is depending a lot on consumer and consumer spending, and we might see a fade of the tax reform in that impact. However, it is true that at the same time salaries are improving, so we need to pay attention at least to an economy that is not so dependent on the external world. Emerging economies is a tale of different places. Improvement in Brazil, improvement in Chile, improvement in some of the Latin American economies, worsening in Argentina, worsening in Venezuela, worsening as well, and careful with this, about India as well, which continues to see its currency get weaker. What we need to do simply is to understand that the whole concept of synchronized growth was a fallacy, but the concept of synchronized slowdown as well, and that the challenges of the Eurozone and the challenges of Japan are deeply rooted in structural problems: demographics, high debt, high government intervention, and defending low productivity sectors and subsidizing low productivity at the expense of the taxpayer and of high productivity sectors. So those economies are much more, let's say, in a less of an advantageous position to defend managing a slowdown than the US, China, or, for example, Brazil right now. Thank you very much, and see you in the 6th episode.